Hello everyone. In this video I'm going to be walking through a tutorial on financial statement construction. For the video I'll be using the notes on financial statement construction and two spreadsheets. One of these I provided for you online. It has the balance sheet, income statement, and statement of cash flows in it, and the other one is just a blank workbook that I'm going to be using to make a few small calculations as we go through the tutorial. So I'm going to start here with the document that I provided called Financial Statement Construction Review, Tasty Lemonade, a tutorial on financial statement construction. The idea behind this lesson and this tutorial is just to provide you a basic framework on how to construct the financial statements for a firm. I'm not an accountant. There might be some things that I do here that make you squirm if you are, but what I want to show everyone is just where the numbers and the ideas on the financial statement come from and how to make a basic financial statement. So we're kind of using the same language as we go through the class. So in this case we're starting a lemonade stand, and we're going to construct the balance sheet for 2 periods of time, an income statement for 1 period of time, and then a statement of cash flow for that period of time as well. After this tutorial, through the video in class, we're going to continue on this lesson and make those financial statements a little bit more complicated and more complex, and it adds some additional things to it. So just going through the tutorial here, you have decided to open a lemonade stand. You will spend $800 for the stand. For each glass of lemonade you will need 1.25 lemons, 1/8 of a cup of sugar or 0.125 cups, 1 cup of water, and 1 cup. Additionally, you will need 4 pitchers that cost $15 each. You expect the stand and the pitchers to last for 4 years, and you will depreciate their cost evenly over those 4 years. And a key thing here is that you're depreciating the cost evenly, and then there's no salvage value. There's no money at the end that it's worth. So we're completely depreciating it. If you're familiar with straight line depreciation, that's what we're using. We're just dividing up the value by 4 and using that for the depreciation expense each year. Lemons cost 30 cents each, sugar costs 20 cents per cup, water costs 3 cents per cup, and the cups cost 7 cents each. What is the cost of goods sold for each cup of lemonade? And this cost of goods sold is also going to apply to the value of our inventory, because we're going to calculate the value of inventory based on the number of cups we can produce. So I'm going to go to the blank spreadsheet that I mentioned earlier, and I'm going to calculate up the cost of goods sold for 1 cup of lemonade. So again, what I need is that I need lemons, sugar, water, and a cup. So how many units of lemons do I need? According to my recipe, and it is a real recipe, I have a miniature lemon tree. Lemon trees don't grow real well in Kansas. That I bring in and out during the seasons, and it generally produces 1 or 2 lemons. This year's actually looking very good. It looks like we're going to get several lemons. And what we do is we actually make this recipe with lemonade and make lemonade. So I'm going to use 0.125 cups of sugar, or 1/8 of a cup of sugar, 1 cup of water, and 1 cup. And then my price per unit my lemons cost 30 cents each. My sugar cost, down here, 20 cents per cup of sugar. Oops. My water, and it's the expensive stuff, costs 3 cents per cup. And my cup itself just costs 7 cents. So now what I'm going to do, I'm going to make this formatted correctly. There we go. I'm going to multiply the units by the price per unit. Drag that down there. And then so my total is going to be the sum of those products, which is 50 cents per cup. So the cost of goods sold for each cup of lemonade is 50 cents per cup. And that's a number we're going to use as we go through our tutorial today. You purchase enough inventory for 100 cups of lemonade, and you open your lemonade stand on July 1st, 2022. And I picked that date because it's not a good time to start a lemonade stand at the beginning of January. It's a little cold outside for that. So we're starting during the middle of the summer. To help pay for your stand, you borrow $500 from your rich uncle. The loan is due on June 30th, 2023, and will accrue interest at a rate of 10% that will be due with the principal on that date. You will pay for the remainder of necessary startup costs out of your pocket. You also keep $100 in cash on hand to pay for additional supplies if needed. So the lemonade stand and the pitchers should be considered fixed assets. I don't know that pitchers normally would be considered a fixed asset, but we're going to use it as a fixed asset in this example. The first thing we're going to talk about is the balance sheet. So what is a balance sheet? A balance sheet is a financial statement that reports a company's asset, liability, and shareholders' equity accounts and their values. Sorry about that. At a specific point in time. Okay. So what I want you to think about when you see a balance sheet is that it'll usually say as of a certain date, and so it's the as of the end of the business day on that day. So it's the value, how much cash they have on hand, the value of their inventory as of that point in time. Liquidity refers to the speed and ease at which an asset can be converted to cash. Liquidity has two dimensions. They are the ability to convert quickly to cash without a significant loss in value. So, for example, houses tend to be fairly illiquid assets. In other words, they're not very liquid. So if I tried to sell my house today and I needed the cash right now, I'd usually have to drop my price by quite a bit from the actual economic value of my house, because houses are fairly unique things and they are generally stuck in one place. So you have to find a buyer who wants your type of house in the location in which it sits. Which can be hard to do, which can take quite a while. I've sold a few houses, and it'll often take a few months, in a good market, to get that house sold. So if I want to sell it quickly, I want to convert my asset to cash quickly, usually I'm going to take a hit on the value of the asset. So the closer to cash an asset is, the more liquid it is. Assets and liabilities on the balance sheet are generally listed in order of decreasing liquidity. Decreasing liquidity. So the first asset on most balance sheets is cash. It's already cash. It doesn't have to be converted. You're not going to lose any value converting it to cash because it's already there. So that's the most liquid asset that a firm has, is its cash. And then we generally go down to things like accounts receivable and inventory. So things that we expect to convert fairly quickly and fairly easily to cash. So what are some liquid and illiquid assets? So liquid assets include cash, marketable securities, short-term investments. And these are all things that you'll likely see on a balance sheet for a large firm. So the marketable securities and short-term investments, those are going to be things like money market funds or commercial paper that they've invested in, or short-term government treasury bills, things that earn a little bit of interest but are very easy to convert over to cash without losing value. They're also hopefully going to include things like accounts receivable, and these are represent the amount that usually suppliers, or excuse me, customers of the firm owe the company. They purchase things on credit that generates an accounts receivable for the firm selling the product, and we hope usually that those accounts receivable get paid in a timely manner, and also the inventory in most cases for a firm, except in cases where the things they sell are things like large capital assets or land or things like that. You know, when we think of most companies, though, especially a lemonade stand, we're going to make lemonade. Hopefully it doesn't sit around for a year. We want to sell that pretty quickly. Illiquid assets. Include things like land, buildings, equipment, and intangible assets. And those intangible assets might be things like, you know, intellectual property like copyrights or goodwill or things like that for the firm. The value of its trademarks, for example, would be an illiquid asset usually. A current asset are assets that are expected to be converted to cash within 1 year. And that 1 year within the balance sheet date of the date of the balance sheet. What are some of the items in the example? Which of the items, sorry, in the example are current assets? Are cash and inventory, and that inventory consists of water, sugar, I can't forget lemons, and cups. Sorry, shouldn't go that fast there. Okay, so those are the things we expect to convert to cash. We're going to make our lemonade using those items, and we're going to sell them for cash, hopefully within the next year. Okay. Now we're going to move on to the long-term assets for the firm. The long-term assets of the firm are assets that we don't expect to be converted to cash in the next year. So our definition of a long-term asset: long-term assets are assets that are not expected to be consumed or converted to cash within 1 year of the balance sheet date. And then what is a fixed asset? A fixed asset is a type of long-term asset. A fixed asset is a long-term asset that is also a tangible piece of property, land, or equipment that a firm owns and uses in its operations to generate income. Okay. So the key things here, two items that make a fixed asset. It's long-term and it's tangible. And then finally, I should say three things, it's used in its operations of the firm. So you can have other assets out there, such as a piece of land that's not used in the operations of the firm. And land, and I'll just set this aside, land is not generally depreciated like equipment and buildings are. Things that are long-term assets that aren't fixed assets would include things like long-term investments, long-term, so like financial assets, things like goodwill, other intangible things such as copyrights and trademarks. Those aren't fixed assets because they're intangible. Okay? They're intangible. So what is the value of the fixed assets? The value of gross fixed assets is usually the historic cost of the asset. In other words, what did the business pay for it? There are some exceptions to this, but in the examples we're going to be working, those exceptions don't apply. So on our balance sheet, you're going to see gross fixed assets versus net fixed assets. Gross fixed assets, the value of net fixed assets is equal to the value of gross fixed assets minus the accumulated depreciation. Right, so our gross fixed assets, again, are generally the historic cost. And then as time goes on, we accumulate depreciation expense against those assets that we have, and it reduces the value of those on the balance sheet, and that the net value of the gross fixed assets minus the accumulated depreciation is the value of net fixed assets on the balance sheet. So going on to some other areas, is the loan your uncle made you a current or long-term liability? Well, if you go back up to the description of the loan, the balance sheet date is July 1st, 2022. The loan is due on June 30th, 2023, so it's 1 day less than a full year. So it's actually going to be a current liability. So it's a current liability because it is due within 1 year of the balance sheet date. If you get into some more complicated financial statements, you might notice an account on the balance sheet called current maturities of long-term debt or something like that. So if you have a long-term debt out there that is a term loan, in other words, the principal is paid down over time, the portion of that principal that's due within the next year is counted as a current liability, a current maturity of long-term debt, and the remainder of the principal value is then classified as a long-term debt. We're not going to get that technical on this example, but it's something you might see out there. So what is the accounting identity? This is also known as the accounting equation. And the accounting equation says that total liabilities are equal to, not total liabilities, total assets are equal to total liabilities plus stockholders' equity. And you might also see this as just owner's equity or equity. It generally just means the same thing. So what we're going to do now is we're going to calculate up that balance sheet for day one of our lemonade stand there. And so that we can answer this question based on the accounting identity, what is the amount of equity investment in your firm? So the amount of equity is going to be the value that makes our total assets equal to our total liabilities. And so the instructions I have here are construct a balance sheet as of 7/1, July 1st, 2022. And we're going to use the blank provided in the Excel workbook. So go ahead and open that up. We've got the balance sheet here. I'm going to fill out this balance sheet just using the information in the tutorial. So I'm going to scroll back up here. And my cash on day one says that you will also keep $100 in cash on hand to pay for additional supplies. So it's $100. We don't have any accounts receivable for two reasons. The first reason is that we haven't sold anything yet. The second reason is that we don't sell on credit, because that's not a good idea to sell lemonade on credit. Just really doesn't work well. The value of our inventory, so we have enough inventory to make 100 cups of lemonade, so that's what we're going to put in here. It's going to be equal to 100 cups of lemonade multiplied by 50 cents per cup. That's what we decided or calculated as being our cost of goods sold per cup. So our inventory is worth $50 on day one. So our total here is equal to the sum is $150. Our fixed assets consist of the stand plus the four $15 pieces, pitchers. So that's going to be equal to $800 for the stand plus 4 pitchers multiplied by $15 each. Oh, it's going to give me a little beep if I don't take this out. Excel does not like it whenever I put dollar signs in those equations or those formulas. So the value of my gross fixed assets is $860. So again, that's the stand plus the 4 pitchers at $15 each. This is day one for the company, so we don't have any accumulated depreciation. So that will be 0. So our net fixed assets on day one are equal to $860 minus our accumulated depreciation of 0, or $860. So our total assets are equal to the $150 in current assets plus the net fixed assets of $860. Notice that I only use those two numbers and not all the rest of the numbers, because those other numbers are used to calculate the total current assets and the net fixed assets. So our total assets on day one are equal to $1,010. Our current liabilities, we don't have any accounts payable because we didn't buy anything on credit. If we had bought our sugar or our lemons or anything like that on credit, we would have an accounts payable value, but we don't here. Accrued expenses, we don't have any accrued expenses either. This is day one. And our notes payable, that's going to be the $500 loan from our uncle. So our total current liabilities are equal to the sum of the accounts payable, the accrued expenses, and the notes payable, or $500. We have no long-term liabilities. And so now I'm going to put in our retained earnings are going to also be 0 because we haven't started operations yet, so we haven't earned any money to retain. And so the value of our total liabilities and equity so far are equal to our total current liabilities plus our long-term liabilities plus our common equity plus our retained earnings. So our total liabilities and equity at this point are $500, but our total assets are $1,010. So we have $510 worth of assets up here that haven't been paid for using our sources of financing, namely our loan from our uncle. So we have to come up with the difference. We have to come up with the difference between our total assets and our total liabilities and equity for this time period, because this is day one. As we go through this, we're going to work one more year of this example in this video tutorial. And then we're going to do an additional 2 years after that in class. And what you're going to see is that this number doesn't change. And that's fairly realistic because for most companies, after that IPO, there's very little change, usually, in the amount that investors actually invest in the company. So our common equity value here is $510, and that is just the difference between the total assets and the total liabilities and equity. That's the value that we're having to put in as investors to make our balance sheet balance. And that represents an actual investment of $510 from the owners into the company. So our balance sheet balances now, our total assets are equal to our total liabilities and equity. I'm going to go back over to the document here. Scroll down to the place that we're at. And I apologize for what is the value of the fixed assets. I'm going to go ahead and put that $860 in here. I noticed it as I was typing it that I hadn't put that in, but it's the $860, which is equal to the $800 for our stand plus $60 for pictures, which is 4 at $15 each. So we've constructed the balance sheet. Based on the accounting identity, what is the value of your equity investment? That's going to be the common equity. So our total assets are equal to $1,010, and that's going to be equal to our liabilities of $500 plus our stockholders' equity of $510. If you go back to the accounting identity, total assets $1,010, total liabilities $500, stockholders' equity is $510. And again, you shouldn't use this as a plug number in the future years because that's not, in our example, that's not going to change. For most firms, that's not going to change unless they issue additional equity. Okay. And we'll talk more about that in the course. So during the year, you sold 2,000 glasses of lemonade. You charged 90 cents per glass. At the end of the year, you paid off the loan to your uncle with interest. You have $219.75 in cash on hand and enough inventory to make 200 glasses of lemonade. You were the only employee, and that's critical here, and took no salary and also did not pay yourself any dividends, so you worked for free for the year. The tax rate for your company is 15%. So now we're going to move on to the income statement. What is an income statement? Or what is the income statement? An income statement is a financial statement that lists a company's revenue, expense, and profit accounts and their values over a period of time, which is typically between the two balance sheet dates. Because remember, the balance sheet represents a point in time. Well, the income statement and also the statement of cash flows, which we're going to come to, tell us the story of what happens between the two balance sheet dates, how we got from the values on one balance sheet to how we got to the values on the other balance sheet. Depreciation expense is an interesting expense for a firm. It's unique, or somewhat unique, in the fact that it is a non-cash expense. That recognizes the cost of a fixed asset over the useful life of the fixed asset. So we're going to come back to this idea of a non-cash expense. A lot of our expenses on the income statement are cash expenses. So if we see an expense for salary, if we see cost of goods sold, that's at some point in time, that amount of value is going to be paid out using cash. In the case of depreciation expense, that value is not being paid out in the amount given for the year, because we're depreciating the cost of the asset that we purchased over the useful life. And that follows, in accounting, that follows the matching principle. We're matching the allocation of the cost of an asset while it's being used, and while it's being used up, rather than buying a big asset like our stand and saying, you know, just expensing the whole $800 in the first year, because we know we're going to use that stand for several years. So using the information provided above, construct an income statement for the fiscal year ending July 1st, 2023. So that's what I'm going to do here. I'm going to go over to our financial statements again. I'm going to go to the income statement. Our net sales for the year. Let's scroll back up here. During the year, you sold 2,000 glasses of lemonade for 90 cents per glass. So my net sales are going to be equal to 2,000 glasses of lemonade multiplied by 0.90. Our cost of goods sold doesn't change. It's still going to be 50 cents per glass. So I sold 2,000 glasses of lemonade. That cost me 50 cents per glass, not $50. That would be very bad. There we go, $1,000. And so my gross profit is equal to the $1,800 minus the $1,000, or $800. We don't have any selling, general, and administrative expenses for the year. We didn't do any marketing. We don't have really any overhead. We didn't pay any salaries during the year. So this is zero for our first year. This is also, you might hear it referred to as SG&A expense. And then our depreciation expense for the year, again, we're using straight line depreciation, so we're just dividing the cost of our fixed assets over their useful life. So the value of our fixed assets was $860. And we said the useful life of these assets is expected to be 4 years. And so we're going to divide that 860 by 4 to get our depreciation expense for the year. So our depreciation expense for the year is $215. And as you might notice, I'm going through and formatting my cells as I go through here. So our earnings before interest and taxes, or EBIT, is equal to our gross profit minus our SG&A expense of 0, minus our depreciation expense of $215. Our interest expense, remember we borrowed $500 from our uncle, and he's going to charge us 10% interest for that year that we borrowed it for. So our interest expense in this case is going to be equal to our $500 that we borrowed, multiplied by the 10% interest rate. So it gives us an interest expense of $50. So our earnings before taxes are equal to $585 minus the $50 in interest expense. And then we're going to pay a 15% tax on that earnings before taxes. And another name for that is taxable income. So our taxable income for the year was $535. And we're going to take out 15% of that for taxes. So I just take the earnings before tax multiplied by the tax rate of 15%, and that gives me a tax expense of $80.25. So my net income for the year is $535 minus $80.25, or $554.75. According to the tutorial, we didn't pay any dividends this year, and so our dividends for the year are 0. So our addition to retained earnings is equal to our net income minus our dividends, or $454.75. And so now what we can do is construct the next year balance sheet, the balance sheet for the end of this year, because we have the balance sheet for the beginning of the year and we have the income statement. And I've given you the amount of cash. Now, what we're going to do later on in this example is we're going to construct 2 more years of the statement of cash flows. And I'm going to show you how to calculate the amount of cash that goes on the balance sheet from that. But in this part of the tutorial, I've given that value to you. It's $219.75. So I'm going to go back to the document here for a minute. We've constructed the income statement. Now we're going to construct the balance sheet for fiscal year end 2023. It says make sure that the retained earnings flow appropriately from one year to the next. So what's given in the tutorial is the value of cash at the end of that first year. And it was $219.75. We don't have any accounts receivable. Again, we don't sell any lemonade on credit. It's generally a bad idea. And the value of our inventory, let's scroll back up here. We have enough inventory to make 200 glasses of lemonade. There we go. So our inventory is equal to 200 glasses of lemonade multiplied by 50 cents per glass, because that was the cost of goods sold that we calculated before. We're assuming that the cost of things haven't risen during the year either. And I'm just going through here really quick and formatting stuff. So my total current assets are equal to the $100 plus the $219.75. So my total current assets are equal to $319.75. I haven't bought any fixed assets during the year. If I had, that would show up here in the gross fixed assets. I haven't sold any either. So my gross fixed assets did not change during the year. And now I'm going to subtract out my accumulated depreciation. So we began the year at $0. If there had been a value here, we would add the depreciation expense for this year to that value. But since this is 0, I'm going to just, for completion sake, I'm going to go ahead and put that in here. The last year's accumulated depreciation, even though it is 0, plus this year's depreciation expense of $215 gives us accumulated depreciation at the end of the year of $215. And then my net fixed assets are equal to my $860 minus my accumulated depreciation of $645. So at the end of 2023, my total assets are equal to my current assets plus my net fixed assets for the year, or $964.75. So during the year, we didn't generate any accounts payable. We didn't buy anything on credit. We just headed down to the grocery store. We don't have any accrued expenses because we didn't buy anything on credit, or we didn't owe anyone anything at the end of the year. And then our notes payable also went away to $0. And I'm going to make this look a little bit better here. Oops, not what I wanted to do. Sorry about that. There we go. All right. So my total current liabilities are just 0 at the end of the year. I paid off my uncle. We don't owe anything to anyone else. My long-term liabilities are also 0 at the end of the year. My common equity did not change. I didn't add in any additional money from my pocket. And then my retained earnings are equal to last year's retained earnings. So it works kind of like that accumulated depreciation plus this year's addition to retained earnings. So I'm going to go back out here to the income statement. My addition to retained earnings are down here, $454.75. And so that means my total liabilities and equity are equal to, and I'm just going to, for completion sake, my total current liabilities plus my long-term liabilities plus my common equity plus my retained earnings, $964.75, which is equal to my total assets up here, so my balance sheet balances. So I'm happy about that. Okay. So now I'm going to go back to the document. We've calculated our balance sheet for the second year. So if we have at least 2 years of balance sheets and 1 year of income statements, we can create a statement of cash flows. As a financial statement, the statement of cash flows is a fairly recent addition to the required financial statements that firms are required to provide. In 1987, FASB, which stands for Financial Accounting Standards Board, issued statement number 95 that mandated that firms, and these are publicly traded firms, must provide cash flow statements as part of the reporting requirements. And the reason for this, or one of the many reasons for this, is that companies and managers have historically been able to manipulate or kind of control earnings. So they, through the use of accruals, like your accounts payable and your accounts receivable and your accrued expenses, could make earnings, could massage earnings. Okay, so earnings, the quality of earnings is a big topic in accounting, and so the quality of the value, the amount, that number you get from management on the financial statements is open to a little bit of interpretation. But the thing is, it's really hard to fake cash. Okay, on my balance sheet, it gives me a number for cash, and I should be able to, on that balance sheet date, look back and see how much cash was in the bank for the firm, and it should match. Okay, so the amount of cash the firm has, we can trace it, we can look at it, we can make sure it's the right amount. So it's hard to fake cash. And so the statement of cash flows, especially for a financial analyst, is extremely important to be able to understand and to kind of trust the numbers that we're getting from a firm. So we're going to calculate the statement of cash flows for this company. We're going to be using the indirect method. There's two general methods of calculating a statement of cash flows. There's the direct method, and that's not used terribly often for publicly traded firms. And then the indirect method, which is the more common approach, and that's the approach I teach in this class. So when constructing a statement of cash flows, it's important to remember the sources and uses of cash for a firm. So where does cash come from and where does it go to? Sources of cash increase the amount of cash that the firm has and should be reflected as a positive number in the statement of cash flows. And uses of cash decrease the amount of cash that the firm has and are reflected as negative numbers. Now, a question that commonly comes up is, what about cash itself? Because cash is an asset, and it says an increase in an asset here is a use of cash. Well, this is for our statement of cash flows, and we don't actually include that in our cash flows from operations. This is the conclusion of our statement of cash flow, is the actual change in cash. So you don't need to worry about cash for this first one. But our other assets, it makes sense that if we increase the value of an asset that is not cash, it's a use of cash. So if we increase our inventory, we have to pay for that. And so that's going to come out as cash at some point. If we buy a fixed asset, that's going to be a use of cash. We're going to have to pay cash for that at some point in time. If we sell off or reduce the value of an asset on the balance sheet, that, again, not cash, would be an increase in cash for the firm. So if we sell inventory, we're going to eventually receive cash. If we reduce accounts receivable, so what happens in that case generally is that we reduce accounts receivable when a customer pays us what they owe us, so they give us cash. It's a source of cash, and we reduce the value of that asset, accounts receivable, on the balance sheet. So that makes sense. The other types of accounts, the liability and stockholders' equity account, we flip that source and use. Okay? So an increase in a liability is a source of cash. When you take out a loan, or when a business takes out a loan, in exchange for that financial security document, that loan, they receive cash. So an increase in a liability is a source of cash. And a decrease in a liability means we're paying off that liability. We're reducing the liability, just like with our uncle's loan. The liability the amount of that liability fell. It was a decrease in a liability of $500. That's a use of cash. We had to pay that cash out to our uncle. And the same thing holds true for stockholders' equity accounts, although we're going to talk about dividends because it's not necessary. It's not really an equity account on the balance sheet. We treat those a little bit differently. But if we increase that common equity account, meaning that equity investors invest more money, that's a source of cash. If we reduce that stockholders' equity account or that common equity account on the balance sheet, that usually means that the firm is repurchasing its stock and it's just eliminating those shares of stock. And so as a result, that's a decrease in the equity account. It's a use of cash because they're using cash to repurchase that stock. So this is an important thing to remember as we're constructing our statement of cash flows. So that's what we're going to do now. We're going to go back to those balance sheet or those financial statements, and we're going to construct our statement of cash flows for this 1 year period of time. So I'm going to go over here to my statement of cash flows, and again, we're using the indirect method. So you might see other statements of cash flows, and you might look at those and say, those don't look much like what we did in class. That's because those are probably using the direct method. As I mentioned before, though, the most common method that we see is this indirect method. And the approach to this method is that we're reconciling the net income from the statement of, from our income statement back to cash. Okay, so we're making adjustments to our net income to get the cash value from that. So we start off with our net income for the year. So I'm going to set this equal to, and then go to the income statement. Our net income from the year was $454.75. Now notice that I'm not using the addition to retained earnings, and this is a common mistake that I see. We're actually going to take out dividends in the statement of cash flow, so we don't want to take them out before that. We're going to add back our depreciation expense, and again, this is because it is a non-cash expense. And we're reconciling that net income value back to cash. Our change in accounts receivable. So the reason why this is included in here is because we start off that income statement with sales. And it's kind of the assumption that those are all cash sales. But in the case when they're not cash sales, when we sell things on credit, we'd actually want to reduce the cash amount by the change in the accounts receivable, because that's cash we're not receiving yet. Okay. In this case, we didn't sell any lemonade on credit, but I'll just for completion's sake go out to the balance sheet and I'll show you how we would type this up in Excel. So I'd put in equals negative. I'm putting that negative there because an increase in this in an asset account is a use of cash. So we'd want a negative number if this value went up. Equals negative, and then I'm going to go to the balance sheet and open parentheses. I'm going to scroll up here, which says accounts receivable. I'm going to use the most current period's accounts receivable minus the amount for the previous time period. And it's going to be 0 because nothing changed there. Now I can pull this down because, and just to make it clear what I'm doing here, to do the same thing for inventory, I'm just going to pull that cell down one. So again, I'm putting a negative. I'll show you down here. All right, so I'm using the negative open parentheses. Balance sheet C6 is the 2023 value of inventory, which was $100 at the end of the year, minus balance sheet B6, which is the value for 2022, the previous year, which was $50. It's so it represents an increase in in inventory, not accounts receivable. It's an increase in inventory of $50. That's a use of cash because we're going to have to spend cash to purchase that sugar, to purchase that water, to purchase those lemons, and so on. Now, accounts payable and accrued expenses are liability accounts, so we don't put that negative number in the front. So I'm going to say this is equal to, no negative, go out to the balance sheet, the most recent year, accounts payable minus accounts payable for the previous year. Of course, it's going to be 0 because we don't buy any of our stuff on credit yet either. And there are no accrued expenses for this time period, and so that's also 0. So our cash flows from operations are equal to the sum of all of these items above it. And that's going to be $619.75. So for the year, we didn't purchase any investments and we didn't sell any. So that's going to be 0. We also didn't invest in any fixed assets. So that $860 we spent on the stand and the pitchers, that was actually paid out in the previous year, prior to the year in 2022. It was our day one value, so it was already accounted for. So we don't do anything with that. Now, in class, we're going to continue on with this tutorial. We're going to add some fixed assets in the coming year, and that's going to show up on our statement of cash flows. But for this value, we can actually go out here. I'm going to put in equals, and then because this is an asset account, I'm going to put a negative and open parentheses on the balance sheet balance sheet. I'm going to go to my gross fixed assets, and I'm going to set my gross fixed assets for the most current time period minus the value for the previous time period, and there is no change there, so this is going to be 0. So our cash flow from investing activities is equal to cash from the sale of investments plus the investment in fixed assets, which is $0 for this time period. So we have the cash flow from operations, we have the cash flow from investing activities, and now finally we have the cash from financing activities, which is our last portion of our statement of cash flows. So cash from the issuance or payments of notes payable, this is going to be equal to the change in the value of the notes payable for the year. So I'm going to go, again, no negative here because this is a liability. I'm going to go to the balance sheet. And our most recent time period notes payable was $0 because we paid that off. Remember, we paid our loan off from our uncle. At the beginning of the time period, it was $500. So this shows up as a negative number, as it should. It's a use of cash of $500. We used $500 of the cash that we generated during the year to pay off our uncle. Cash from the issuance or payments of long-term debt. And you might notice the payment are in parentheses because they represent a negative number. So this is going to be equal to our long-term debt, or I use long-term liabilities here, for this year minus the long-term debt at the end of last year. And the difference here is 0 because we don't have any of either. Cash from the issuance or repurchase of equity. You can use the common equity account in our example here for this. Again, there's no change, but we'll just put it in for completion's sake. It's equal to the change in the common equity account. So there's no change there, so it's 0. And again, we didn't pay any dividends during the year. And I'll just go out here to my income statement for the dividends paid for the year. And hopefully what you saw here is that I used, with the exception of this one here, and I probably could have, but I used accounts from the balance sheet and the income statement directly to fill in these values. And that's how we generate our statement of cash flows. And what you'll see hopefully is that they all flow together. These financial statements all flow together. And that's one way we can look at them to see if they were constructed properly. So our cash flows from financing activities are just equal to the sum of these 4 items. So it's just negative $500 for the year. Our net cash flow is equal to the sum of the cash flows from operating activities, the cash flow from investing activities, and the cash flows from financing activities. So that's what I'm going to put in here, equals. Our cash flow from operations was $619.75, plus the cash flow from investing activities was 0. Oops. Plus finally, the cash flows from financing activities was $500. So our net cash flow was an increase in cash for the year of $119.75. We're going to use that down here as the change in cash. So our beginning cash is the value from the balance sheet. So at the end of last year, it was $100. So that's the amount of cash we started with at the beginning of this year. Our changing cash during the year was $119.75. So our ending cash should be the sum of the two, or $219.75. So for this first full year of operations, I gave you the cash amount. As we go through a few more years of this example again in class, I'm not going to give you the cash amount for at least one of those years, and you're going to have to find that out, figure that out for yourself. But I've just shown you how to do it. We didn't need that cash amount to calculate any of these values in the statement of cash flows. That ending cash amount matches the amount I gave you here for the balance sheet for the year. All right. So let's go through and check everything. I've got a simple check that I use out here on our document. So if you scroll down on the document, we've now constructed everything. And I asked the question, are the financial statements constructed correctly? So a few decades ago, I was a financial analyst for a couple of different banks. And I worked with some small accounting firms where, we'd have a borrower and borrower would use an accounting firm there in town, and that accounting firm would send me over the financial statements for the borrower. And there were several different, accounting firms that did this. And part of my job as the analyst was to analyze the financial statement. So one of the first things I would do is to make sure that all of these three things were correct. And unfortunately, there were several occasions where they weren't. So I would sometimes get financial statements where the balance sheet didn't balance. And I had to make an awkward phone call then. I have to call up the accounting firm and say, they knew who I was. And I would call up and say, there's a little problem with the financial statement here. The balance sheet doesn't balance. I need them reworked before I can give your customer and my borrower an answer to their loan request. So that kind of put them in a tight spot. And I said, honestly, I just can't trust anything on the balance sheet if it doesn't balance, because there is something, at least one thing wrong here. So they'd have to go through and redo their work. So it's a good thing to make sure that these three things apply when you're looking at financial statements for a firm. The first thing, does the balance sheet balance? I've got it here in the wrong order, but it still works. Stockholders' equity is equal to assets minus liabilities, or assets, total assets, are equal to total liabilities plus stockholders' equity. So if we look at the financial statements that we created today, they work. So looking at my balance sheet, yep, my total assets are equal to my total liabilities plus equity. Total assets equal total liabilities plus equity. So I'm happy about that. Second item, do retained earnings flow appropriately? Does this year's retained earnings equal last year's retained earnings plus this year's net income minus this year's dividends paid? And if I go out there and look at that, again, it does, because last year's retained earnings were $0 plus this year's net income of $454.75 minus this year's dividends paid, which was 0. Results in, and that's how we calculate the addition of retained earnings, results in our retained earnings for this year of $454.75. So once again, the retained earnings flow appropriately, so I feel good about that. The last item, does cash reconcile from one year to the next? And what that means is that this year's cash balance on the balance sheet is equal to last year's cash balance plus the change in cash from the statement of cash flows. So I'm going to go back out here, look at my statement of cash flows. Well, actually, I'm going to go back to my balance sheet. Sorry about that. Last year's cash on the balance sheet was $100, and this year's was $119.75. The difference between those two is $119.75. And so my cash does flow appropriately during the year. I start off with $100. My changing cash was $119.75. So my ending cash on the balance sheet was $219.75. So that's it for this video tutorial. Let me know if you have any questions about this, and in class we're going to continue on with this with the document I'm going to provide to you, and we'll work through some additional years of this spreadsheet where we're going to add on to this spreadsheet in class. So again, please let me know if you have any questions. It's especially helpful if you let me know prior to our next class meeting, so you have all the right information and you have everything down prior to that meeting. And I look forward to seeing you soon.